Want to learn about investing? Today, I'll be sharing what exactly is investing and why you should start right now. Hello everyone, welcome to the NASTI Dynasty, where we all learn about life-changing habits, skill sets, and mindsets to help us all become more nasty. Today, I'll be discussing about the hot topic of the year, which is investing. I don't know about you guys, but I've been asked this question a lot. What will you do if you win the $4.5 million Toto from today? Back in the past, I've always wanted to say, buy a house, buy a car, eat good food, travel, and just zao bro. But as you all know, that's the wrong answer. The correct answer will usually be to first give your parents XX amount of money and then invest the rest of the money. This is actually what I'll be doing now, not because it's politically correct or anything, but because this answer actually makes the most sense. Back in the days, I actually used the word investment because it made me sound cool and smart and everything, but I actually didn't know what exactly investment consists of. But right now, I actually know to a certain extent of how investing works and how having just a little bit of knowledge about it can help us so much in the future, which is why I want to share it with you guys. So let's first understand what is investing. According to Investopedia, investing is the act of allocating resources, usually money, with the expectation of generating an income or profit. But basically, in layman terms, investment is where you find somewhere to put your money into where it will probably give you good returns if you don't do anything stupid. But for now, I want to go through the 3 main myths about investing that we have heard probably from our parents or the people around us that may be hindering us from starting our investment journey. Hopefully after this video, your mindset about investment will shift quite a bit. So let's just jump right into the first myth, which is that investment is very risky. I have repeated this sentence in my previous financial education videos, but let me reiterate it one more time. Investing is not risky. Being financially uneducated is what's most risky. It's the same as how you won't enter the examination hall without studying first. It's basically too risky and you'll probably just get obliterated by the stupid math paper. Let's look at some companies that we all know about, because as a safe investor, you wouldn't want to invest your money in a company that you don't know about, right? Okay, let's use Facebook. So look at this graph. Oh shit! What's that drop? Oh no, investing so risky, zao. Let's zoom out a bit to see the trend for the past 10 years. Overall, as you can see, there's still a general increase in trend. So this drop actually happened during the COVID period last year where the economy was not doing very well. But as you can see, as the economy recovered, the stock price also recovered with it, reaching all-time highs. I'm sure that Facebook alone is not enough to convince you. So look at all these graphs. But basically, investing is not as risky as what your parents and your financial advisors might be telling you. It is really all up to how you do your due diligence to acquire the relevant knowledge required to take the first step into your investment journey, and not just throwing money into a random company that you don't even know about. So let's move on to the second myth, where some people feel that if you were to invest in a company, either the company is going to zao with your money or the broker is going to zao with your money. So I'm sure that all of you know what's a company, so let's just talk about what exactly is a broker. A broker is an individual or firm that acts as an intermediate between an investor and a securities exchange. To put it in simpler terms, you can't exactly walk up to Mark Zuckerberg or send him an email to tell him that, hey, Lim Pei want to buy your shares. Like, the whole process will be so messy if they allow everyone to just walk through the door like that. And that's why we have to go through a third party, which is the broker firm for such transactions in exchange for commission fees. So I will guess that if a broker were to run away with my money, I will probably have $0 inside my brokerage account. Or when I try to open a brokerage account app, I'll probably be unable to open it and you'll just be unable to respond. There are actually a lot of security checks that brokers have to go through in order to fully establish themselves as a brokerage firm. There are also a lot of laws that ensure that brokerage firms are unable to run away with your money just like that. At least for legitimate brokers and not those kind of scammy brokers. And let's say even if the broker goes bankrupt, your money will usually be returned to you either by law or through a custodian, which is something like a fourth party that your brokerage firm will place their funds with, once again for security reasons, to ensure the safety of your investment. Whereas for companies, I would guess that if they were to zao your money, they have to first tear down all the office buildings in the entire world before they can even do that. So I believe that practicality wise, it's almost impossible for a company to suddenly disappear from the face of the earth. But a company can indeed go bankrupt, and if they were to choose to declare bankruptcy, as investors, we should have seen it from miles away because the stock price will just slowly be dropping. So it really depends on how you do your own due diligence and research. Moving on to the third myth, many people feel that investing requires a lot of money. Well, this is actually not true unless you are looking for investment opportunities that require a higher amount of initial capital, like for example, real estate, where I think the down payment is probably more than my entire net worth. Whereas if we look into stocks, for example, we don't really need that much money to start with. Actually, most brokers right now don't even have a minimum amount that you need to deposit into the brokerage account, but there are transaction fees when buying and selling stocks, which makes having $50 not very practical in a sense, but it is still possible. Let's just use an example where you want to buy an item from Lazada or something. If there is a fixed delivery fee, for example, wouldn't you want to buy more items to make the most out of your money? This concept applies to stocks as well, which is why many people have a misconception of how you need to have a huge amount of initial capital when it's actually not needed, but more of being recommended in a sense. So basically what I'm trying to say is that investment is not as risky as what other people say it is, and anyone can start anytime to slowly grow your money. But I personally feel that all the information that I provided just now are definitely not enough to help you kickstart your investment journey. So let me give you 3 main reasons why you should just start investing right now. The first and the most important reason is the power of compounding. I'm sure you have learned a thing or two about compound interest during math in secondary school, so the concept is around the same. Let's take a look at this O-level question, for example. Okay, so blah blah blah. Basically, Adam earns a shit ton of returns from just 4% compound interest a year for 18 years of leaving his money in a savings plan other than a bank. So when you actually choose to take charge of your own personal finance versus when you choose to let someone else take charge of your personal finance, the returns are definitely much different, and also you get to learn so much more. So let me just introduce you to this index fund which tracks the top 500 companies in the US, also known as the S&P 500. There are actually 3 types of funds: index funds, mutual funds, as well as exchange traded funds, also known as ETFs. Funds are basically a compilation of different stocks to help investors diversify their portfolio without actually buying the individual stocks themselves. But basically, the S&P 500 is an index fund with an average return of 13.6%, which is more than Adam's savings plan, by the way. But anyways, let me just use this online compound interest calculator. So let's just say that we put $300 into this S&P 500 index fund every single month, and we do this from 21 years old until 55 years old, which is when you can take out your CPF money. For average returns, we'll just assume a 13.6% average annual return. Boom! Congratulations, we have a winner. Let's just say that you don't want to invest until
you have the money,
which is what most people actually say. So let's say that you start at 30 years old, which is just 9 years from now. But since you have money, you can put in twice the amount, which is $600 every month instead. And boom! Even though you put in more money during the 24 years of investing, because of the fact that you were too late to invest and you missed out the 9 years of compounding, you are unable to buy your first Lamborghini in cash. But anyways, what I'm trying to show you is just this very small example to show you how you don't always need to exchange time for money, but instead, since we are all starting young, we can let time work for us to help us grow our money. The second reason is because of inflation. Inflation is actually damn scary, but right now we don't really notice it as much because the price increase is not as relevant to us because we are technically all still young. But if you were to ask your parents about inflation, they will definitely say something like, "Wow boy, back when I was in primary school, the 鱼圆面 only cost 50 cents. Now the 鱼圆面 cost 3.50. I mean, for me, I only saw the price of fishball noodles increase from like what, 250 to 350? But when I am 50 years old, I will probably be telling my children something like, wow, back when Lim Pei was in university, the fishball noodle only $3.50. Now it's $8. Yeah, but basically, if you were to leave your money in the bank account at a whopping 0.05% interest rate per annum, sorry to break it to you, but it isn't gonna work because you aren't even able to beat inflation. I would rather you sign up for a savings plan with a financial advisor instead if you don't choose to take charge of your personal finances. This is to ensure that whatever money that you are trying to save does not depreciate in value, and that 10 years or even 20 years down the road, you will be able to buy the same number of fishball noodles, or heck, you can buy even more fishball noodles with the same amount of money that you have saved. The third reason of why we should invest now is actually because we all have a very low risk profile. The risk that I'm talking about here is not about the risks of whether or not you will win or whether you'll lose money during investing, but more of what will happen to you if you were to lose money. Most of us here are still living with our parents and are even taking allowance from them. If somehow we were to lose $5,000 right now, we will still have a roof under our head as well as food to eat. Okay, but anyways, let's just say that at the time where you say that you have enough money to start investing, you have actually moved out away from your parents, you are having your own job, and you might be even starting your own family. Let's say that you lose the same $5,000. The risk that you are experiencing is so much more. This is because you might not be able to pay for your own mortgages, your electricity bills, and even your credit card bills. The worst case scenario that you can experience is that you aren't able to afford your children's milk powder as well as education. Basically, investment in itself has a fixed risk, but because of the fact that we are all still young and we are still taking shelter under our parents' homes, it is actually very easy for us to start investing now without having to worry about what will happen. So, as spoiled as it sounds, this is actually one of the very important reasons why we should start now. Because if we were to start later, you will be experiencing so much more difficulties. Now that I've explained why you should start investing young, let me just go through what you should do right now after this video so that you kickstart your financial education journey with zero risks. The first step that you should do is to choose a broker. For Singaporeans, long story short, just use Tiger Brokers. This is currently one of the best brokers in Singapore in terms of the low commission rates as well as how easy it is to use, because we are able to connect easily to our SingPass as well as our DBS/POSB accounts. I mean, if Singapore allows this broker to have access to your SingPass details, and Singapore being Singapore, you can probably tell that this broker is more or less safe. But if you want to compare the difference between Tiger Brokers and the more well-known brokerage firms such as Interactive Brokers and TD Ameritrade, I've attached some video links in the description, again, for you to look and compare by yourself. I've actually included my referral code so that you can get your 5 free commission trades when you sign up for your Tiger Brokers account. So the entire process of setting up an account is actually super fast. Like, it usually takes less than 1 day. For me, it took 1 hour. Right after your account has been created, immediately transfer funds right into your account. It doesn't matter how much you transfer, be it $5, $100 or even $10,000 if you have that money. This is because if you are using a Singaporean bank account, like for example DBS or POSB, there are actually zero withdrawal and deposit fees, as well as no minimum deposit or withdrawal. So the reason why I actually encourage you to do this is because once you have money inside, you are actually more inclined and you actually force yourself to become more educated so that you don't lose the money, even if you are not trading. It's like how if you want to learn swimming, you don't just go and watch videos about swimming, you have to actually get in the water, right? I have some acquaintances and friends that told me that they want to learn more about investing first before they create their brokerage account and put money inside. But I think most of them haven't even learned jack shit. For me, back in NS in about August 2019, I was actually supposed to open my first DBS Vickers account with my friend, but I forgot to bring my IC. So actually, because of the fact that I didn't go that one time, I did not take the initiative to go and open my own brokerage account or even learn anything about investments, because I was basically just lazy. The next year, in April 2020, the COVID-19 market crash occurred, where stock prices dropped on an average of 30% or more. And because of the fact that I was lazy, I actually missed out on one of the best opportunities to buy stocks. Even up to this day, I still kick myself over and over again because of the fact that I didn't bring my IC that one time. I hope that my story is able to push you to kickstart your financial education journey early on in your life. I'll be posting a part 2 video next week which covers the basics of investment as well as how the market works so that you don't unnecessarily lose money like I did in the past. Always remember to do your due diligence before taking out any investment opportunities or buying any shares or any stocks. Thank you all so much for watching, and I hope that you have learned a thing or two from this video about what exactly is investing as well as why you should start investing at a young age. Do let me know in the comment section below about some additional information that you want me to cover so that I can make the video more relevant for you guys. With that, I will see you next Monday. Always remember, stay nasty.